Welcome back to AlgoBot, the channel where we take apart automated trading strategies and study how they actually work, one line of code at a time. I'm your host here at AlgoBot, and today we're exploring an expert advisor for MetaTrader 5 called Centroid Torque Expansion. It's built on a simple but elegant idea borrowed from physics, measuring how quickly price is being pushed away from its own moving equilibrium. By the end of this video, you'll understand the moving average centroid at the heart of the strategy, the torque calculation that shapes every signal, and how the approach manages its risk using the average true range. This is educational content only, so let's dive in and see how it thinks. Let's start with the big picture. Centroid Torque Expansion is a trend expansion strategy, and it works on a single symbol and a single time frame. You can study it on foreign exchange pairs like euro against the US dollar, or on other instruments, always on the one chart it is attached to. Nothing here reaches across multiple time frames. The central idea comes from mechanics. Imagine a moving equilibrium for price, a rolling center of balance. In this strategy, that equilibrium is an exponential moving average, and the code calls it the centroid. The distance from the current close to that centroid is treated like a lever arm, a measure of how far price has stretched away from balance. The bar-to-bar change in price is treated like a velocity or a force pushing price along. When you multiply the lever arm by the velocity, you get what the strategy calls torque. Mathematically, that torque is the rate of change of the squared deviation from equilibrium. In plain English, positive torque means price is being driven further away from balance. An expansion leg is underway. Negative torque means price is relaxing back toward its equilibrium, and the expansion is fading. The strategy also smooths that torque over a short window, and it compares the smooth value against an adaptive threshold that scales with recent volatility. That means the bar for entry rises in noisy conditions and falls in quiet ones, so the signal self-adjusts to the market regime. Finally, the average true range sets the protective stop and the profit target for every position. Who is this style suited for in an educational sense? It's aimed at people who are curious about systematic, rules-based trading and who like the discipline of a fully defined model. It is not a promise of any outcome. Trading carries real risk, and losses are a normal part of it. We're here to understand the logic, not to predict the future. Now let's walk through the exact logic, step by step. The strategy acts once per completed bar, so it is patient and never reacts to every tick. First, it computes the centroid, an exponential moving average of closing prices, using the CentroidPeriod, which defaults to 40 bars. Then it measures the deviation, which is the current close minus that centroid. This is the lever arm, and its sign tells you which side of equilibrium price is on. It also measures velocity, the current close minus the previous close, which captures the direction and pace of the latest move. Multiply the deviation by the velocity, and you get the torque for that bar. The strategy stores a history of these torque values. It then smooths the torque by averaging the last several bars, using the torque smoothing window, which defaults to 8. Separately, it estimates the standard deviation of torque over a longer statistics window, 60 bars by default, and multiplies that by the threshold multiplier, which defaults to 1.20. That product is the adaptive threshold. An entry is considered only on a fresh cross. The smooth torque must have been at or below the threshold on the prior bar, and then rise above it on the current bar. That single upward cross is the core condition. Once it happens, the deviation decides the side. If price is above the centroid and velocity is positive, the strategy opens a long. If price is below the centroid and velocity is negative, it opens a short. Notice that torque is positive in both cases, because a negative deviation times a negative velocity is still positive. The direction is chosen by the signs, not by the torque alone. For risk, the average true range, with a period of 14, sizes everything. On a long, the stop sits below entry by 2 times the range, and the target sits above by 3 times the range. On a short, those are mirrored. That is a reward to risk of 1.5 to 1. Exits are tied to the same physics. A position is closed when the smooth torque falls to 0 or below, meaning the expansion has stopped, or when price recrosses the centroid against the trade. The strategy also holds only one position at a time, so it never stacks entries. Let's read the actual MetaTrader code on screen. At the top are the inputs. The centroid period sets the length of the moving equilibrium, 40 by default. Torque smoothing averages the torque over the last 8 bars, and the statistics window, 60, sets how the adaptive threshold is estimated. The threshold multiplier of 1.20 scales that threshold with volatility. Then come the average true range period of 14, the stop multiplier of 2, the take multiplier of 3, the trade size, and the magic number that tags the strategy's own positions. Now the entry block. The outer condition is the key. The threshold must be positive, and the smooth torque, called big T, must have been at or below it on the previous bar and now be above it. That is the fresh upward cross. Inside, 2 branches decide the side. In the first branch, if the deviation R is positive and velocity dV is positive, the strategy calls trade.buy. It reads the ask price, sets the stop below entry by the stop multiplier times the range, and sets the target above by the take multiplier times the range. In the second branch, if the deviation is negative and velocity is negative, it calls trade.sell. Here the stop sits above entry and the target sits below, again scaled by the average true range. Both sides share the same trigger but point in opposite directions. It is clean, symmetric, and fully defined in code. Let's watch this play out candle by candle. On the price chart, you'll see the blue line, which is the centroid, our moving equilibrium. In the panel below is the smooth torque, with a gold dashed line marking the adaptive threshold and a gray line marking 0. Look at the first 3 candles. Price is drifting sideways, hugging the blue centroid, and down in the panel the smooth torque sits near 0, even dipping slightly negative. There is no expansion here. Deviation is tiny, velocity is small, so torque is quiet. The strategy simply waits. On the 4th candle, price pushes up and closes above the centroid. The deviation is now positive, the lever arm points upward, and velocity is positive too. In the panel, the smooth torque begins to climb toward the gold threshold. This is the setup building. Now the 5th candle is where it happens. Price extends higher, and the smooth torque crosses above the adaptive threshold into the green expansion zone. That fresh upward cross is the exact condition in the code. Because price is above the centroid and velocity is positive, the strategy opens along. You can see the buy entry marker right here. At the same moment, the stop is placed below, at 2 times the average true range, and the target above, at 3 times, that reward to risk of 1.5 to 1. Through the next candles, the expansion runs. Price climbs steadily away from equilibrium, the blue line trailing beneath it, and the torque stays elevated in the green zone, confirming that deviation energy keeps growing. Then, around the 8th candle, price reaches the take profit target and the long is closed. Notice the torque has already begun rolling back down towards 0, a sign the upward expansion is maturing. The trade is complete. Now watch the market turn. Price stalls near the highs and starts sliding back toward the centroid. As it does, the torque sinks towards 0, which is exactly where the strategy considers expansion finished. The blue equilibrium line flattens, and price cuts back below it. Here is the mirror image. On the 11th candle, price closes clearly below the centroid, so deviation is now negative, and velocity is negative as price falls. Remember, a negative deviation times a negative velocity gives positive torque. Down in the panel, the smooth torque crosses above the adaptive threshold again, back into the expansion zone. This fresh cross, with price below equilibrium and velocity pointing down, opens a short. You can see the sell entry marker. The stop goes above at 2 times the range, the target below at 3 times. From there, the downward expansion carries price lower, candle after candle, further from the centroid, with torque holding above the threshold. Finally, on the last candle, price reaches the short's take profit target and the position closes, just as the torque begins to fade back towards 0. Both the long and the short followed the identical rule, a fresh torque cross into expansion, with the side chosen by which way price had stretched from balance. That symmetry is the heart of this strategy. So that's Centroid Torque Expansion. We saw how it builds a moving equilibrium with an exponential moving average, how it measures torque as deviation multiplied by velocity, and how a fresh cross of the smooth torque above an adaptive, volatility-scaled threshold shapes each entry. We watch the deviation choose the side, and we saw the average true range set every stop and target, with exits tied back to the same physics of expanding and relaxing energy. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation. Trading carries real risk, and losses are a normal part of it, so always do your own research. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy we should study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.